Hey traders, welcome to the global macro update where we run through all of the news that matters for the week, the economic events that are coming, and the charts that are of importance to us this week. So let's get into it. So beginning with the news that matters this week, obviously China's still front and center for us. Really big developments happening there. It doesn't seem to be on the radar too much in the markets and the main market news, but we're seeing some really important news coming out of there. We're just showing that Chinese property crisis is still very much underway, and I believe the contagion is still very much a big threat for the global financial system. So looking at some of the Chinese bonds, the China developer bonds from high grade all the way down to junk, really taking a hit to start the year. As you can see, a lot of them rolling over. You have long fours, you have Logans, you have Country Garden, and you have CIFT really just rolling over into January, just showing you how bad things are compared to where we were in November, where things really started to heat up. We saw a little bit of a bounce, kind of news that it wasn't going to be contagion, things were going to get sorted out by the Chinese government, and yet when we see the effects heading into January, that's just starting to roll over. And when we see something like Country Garden, which is one of China's biggest housing or kind of biggest builders in the country, with more than 3,000 housing projects located in almost every province in China. Obviously, its financial health is going to have immense economic and social consequences. And when we look at the bond, we're seeing Chinese Garden 3.3% notes of January 2031. They are continuing to roll over into January, actually hitting new lows in relation to what we saw in November. So things definitely looking worse in the Chinese sector compared to when the news first struck in October, November, and just kind of continuing with that bad outlook. And then we have developers like IMF, which happens to have business in Australia as well as Canada, saying that they won't be able to repay their dollar debt, and they would be the 8th Chinese real estate firm to default on US dollar debt since October. And that was coming out of Bloomberg, saying that China's yuan says it won't pay bonds, signals default is imminent. So very much bad news coming out of more Chinese developers. And when we look at the yuan share price, you can just see making new lows heading into 2022, just continuing their meltdown that began honestly in earnest in 2020 and COVID first hit, but really accelerating heading into the middle of 2021, as you can see from this chart. So things really not looking good in the Chinese property sector. And what's worse is that we're seeing Chinese home prices rolling over. We're seeing rolling prices dropping to their lowest levels in 2021, and that's just continuing to roll out heading into 2022. So with Chinese property markets prices or Chinese home prices dropping to new lows, just keeping in mind that Chinese investment across the population, 70% of those investments are in properties, a lot of them over leveraged, a lot of them using that property market to protect their generational wealth. And if that's rolling over, we're just going to see increased damage across the Chinese economy, which you're already starting to see, as we'll see moving forward. We're also seeing the property buying frenzy cooling in Shenzhen, which is basically the Silicon Valley of China. Investors are staying away from residential projects in China's Silicon Valley, and that's what we're seeing from SCMP, the South China Morning Post. To make matters worse, CNBC reporting that Chinese developers faced $19.8 billion in maturing offshore bonds in the first quarter of 2022 and $18.5 billion in the second quarter, so nearly double the $10.2 billion in maturities of Q4 2021. So 2022 looking to be a very, very bumpy road ahead for these Chinese developers as their debt continues to roll over, their debt maturing continues to stack up while the economy is slowing down, while the property sector is dropping, while prices are dropping, while investment in the sector is really cooling off. So we can just see how 2022 just may be a continuation of that process of the Chinese property crisis moving forward. As we said last year, these things take a while to roll out. A lot of people think like Lehman was a one-off event that just occurred overnight and things started to crash. Lehman took as long as 18 months to really unfold. So that unfolding only really started to accelerate into the latter part of that 18 months. And this is what I believe we're going to start to see in the Chinese property sector, especially heading into 2022. We're just going to see that continue to roll over. And what we did see out of China was what was seen as positive news is that the Chinese trade data showed exports were almost up 30% last year to an incredible 3.36 trillion, and the trade surplus was as a record. Everyone sees a trade surplus as a record as solid growth for the economic conditions in China, but in reality, trade surplus only occurs when imports are less than exports. And what's that showing to me is that, yes, they continue to export, but the imports are really struggling. And if imports are really struggling, it means the Chinese consumers are really struggling to import goods into the country because they just don't have the funds. The consumption in China has really lagged in the household sector. Decline in the household share of GDP is dropping, and we're just seeing that in those trade surplus conditions, in those trade surplus records. It's just an indication to me that the Chinese economy continues to slow. And that being said, when we look at the news that matters, economic slowdown in China continues. And this is what we're seeing in the graph here. The Chinese growth slows, with retail sales weakening more than expected in heading into the end of the year and the beginning of January 2022. So we're just seeing those economic slowdown continues to drop and continues to abate and continues to show how that economic crisis in China, that property crisis in China, is beginning to hit households, beginning to hit the Chinese economy in a big way. And that's what we saw from China this week, where Bloomberg reported that as Chinese economics slowed, they prompted interest rate cuts. And Chinese easing cycle begins with a bang as the central bank cuts 2 interest rates for the first time since the pandemic's early days. Its benchmark lending rates for corporate and household loans were cut for a second straight month in January, while lowering a mortgage reference rate for the first time in nearly 2 years. So Chinese economy definitely under pressure. PBOC reacting by lowering the mortgage reference rates, lowering interest rates, which just shows they're trying to get liquidity into the markets because those markets are really under pressure. So the theme of this is that 2022, I believe, is still going to be a very bumpy road for the Chinese property crisis, very bumpy road for the Chinese economy, which in turn will have that contagion effect heading into the global economy, especially in commodities. We've seen commodities roll over. We've seen a bit of a rally heading this week in silver, in copper, things like that, but I believe that's going to be short-lived as the Chinese property crisis continues to unfold. Heading over to the US, where we continue to see inflation expectations roll over, as we see here with the 5-year forward inflation expectations rate. We basically peaked in the latter part of 2021 and have continued to roll over since then. So all these people that were talking about inflation being a massive issue in the US, we've always been kind of on team transitory, which is always been the case for us, because we knew from the blueprint of 2008 to 2011 we would be seeing the same thing. And this may just be another kind of offset of the Chinese financial crisis, with that rolling over of inflation expectations. And when we relate it to Bitcoin, it may be a big understanding of why Bitcoin continues to sell off as inflation figures continue to roll over. Bitcoin obviously being a big inflation hedge, and if these inflation figures continue to roll over, it's very possible that we continue to see Bitcoin rolling over. I don't think it's going to be as simple as that. I think there may be a role for Bitcoin in more of the emerging markets, and we'll get to the emerging market debt crisis that is looming. That will be a way for the third world to kind of protect their savings by jumping into Bitcoin, and they may see Bitcoin rally since then. But as we can see, we've been a pretty close comparison between inflation expectations in the US and the Bitcoin price. So we'll be watching that pretty closely to kind of mark where we think Bitcoin will be bottoming out here. But for the meantime, it appears to me that Bitcoin will continue to fall from these levels. When we move over to the employment figure fallacy, where we continue to see new lows in employment figures in the US, which is being kind of pushed as a sign of the economic recovery in the US. But when we look at the levels of the job numbers versus pre-COVID, we can see we are still 3.5 million jobs lower than we were pre-COVID levels, even though unemployment figures are still coming out really strong. And we believe what that is relation to is all to do with the S&P reaching new highs. The S&P continues to rally. Obviously, the crypto market having a big effect there as well, because that's allowing people to not have to seek employment. They are able to live off of their returns they are receiving from record high levels in the S&P, record high levels in Bitcoin. But when we look at the S&P Cape Shiller PE ratio, we can see that's now rolling over from near record levels. Last time we saw levels close to this was at the dot-com bubble. We've now started to roll over heading into 2022, which may be of a concern. And if we start to see those employment figures start to bounce, then we'll definitely have some issues in the US economy as well. And just as a matter of interest, last time the employment figures reached these levels of kind of below 4.5%, it was just before the global financial crisis. So it's kind of a precursor to what we saw back before the global financial crisis. So it's another thing we will be watching heading into 2022. Moving on to German inflation fears, they continue to intensify as the PPI jumped to record levels of 24.2% year on year in December, smashing all estimates. So this was the highest increase ever since the start of the stats in 1949. Compared with the preceding month, November 2021, the overall index rose by 5% in December 2021. So obviously we're seeing big climbs in German PPI, which is pushing up inflation figures in Germany. And we believe, again, probably has something to do with China, Germany being one of the biggest trade partners for China. If Chinese producers are pushing up prices to kind of offset the economic damage that they're seeing in China and local demand, then that's obviously going to push into German figures. Obviously, the supply chain crisis also playing its role, and whether these German PPI figures, CPI figures start to roll over, it's a matter of time. We'll have to just watch if that is going to be the case. Then moving over to the global stage, where the IMF sees economic recovery rolling over. That was reported by CNBC. It said that the IMF chief said that Fed rate hikes could throw cold water on the global recovery. And what that is a problem for is the massive amounts of third world debt, of developing world debt, of emerging market debt that is in the system at the moment. So Kristalina Georgieva said the increase in US rates could have a significant implications for countries with higher levels of dollar-denominated debt, which we have been expecting for basically since the start of the pandemic. You can go back to our video saying it's called the Friendly Warning for Friends and Investors, which we recorded in May 2020. We said we can watch for emerging markets to rally, where that is going to roll over as soon as liquidity starts to stop flowing into the global economy. And as we're seeing Powell already starting to talk about raising rates, we look like March is already priced into increased interest rates. And as those rates increase, we see a massive demand for the dollar, because these third world countries have to pay off the dollar-denominated debt. And with that demand for the dollar, we see the dollar continue to rally, and that's exactly what we expected from that video. She said it was hugely important that the Fed was clearly communicating its policy plans to prevent surprises, but I don't think surprises are going to matter. As soon as the liquidity stops flowing into the system, we're going to have serious issues. And a big reason for that is because the DSSI, which is the Debt Service Suspension Initiative, which was basically there to allow a little bit of debt relief to the emerging markets as a result of COVID. They obviously came under massive pressure after COVID hit. They saw extreme levels of indebtedness among low-income nations as a result of the pandemic, healthcare costs pushing up public spending, while the severe global recession hit output and government receipts. But now that expired in the end of December 2021, they're failing to kind of reinstate that kind of debt relief for those nations. So these guys are now having to pay back $35 billion in official bilateral and private sector lenders during 2022. It's 74 low-income nations which will have to be paying back that debt, which is up 45% from 2020, which was the most recent data available. So $35 billion required from 74 of the lowest income nations in the world, which is obviously going to have a massive impact on the global financial crisis if they fail to pay that. It's obviously going to have a massive impact on the dollar, because these nations are going to have to get hold of $35 billion worth of dollars in order to pay back these loans. And why this is increasingly significant is because when we look at the Chinese lending figures to these nations, these sub-Saharan African nations, these poorer nations, we see China has some massive debt owing to it from these nations that are going to struggle to pay back these numbers. And these are all dollar-denominated debt that are loans that are needed to go to China. And if China doesn't receive this income, it's just going to put a massive strain on its financial burden that it's already holding as a result of the Chinese financial crisis or the Chinese property crisis. So we can see how all of this is beginning to be intertwined. Inflation pushing the Fed to raise rates. The raising of rates will cause a dollar-denominated debt crisis throughout the globe, especially in the poorer nations, as a result of the DSSI rolling over or being expired in 2021. That $31 billion now due to from these nations to pay back that debt, which is going to push the dollar higher. And now the Fed is looking to rate hikes, which is going to exacerbate the problem. And then China is going to struggle to get these debts paid back to them, which is going to put increasing pressure on their financial system, which in turn is going to put financial pressure on the global economy, as we'll see commodities roll over, we'll see inflation figures roll over, which we're already seeing in the US, and all of it's beginning to unwind. And that's how we feel 2022 is going to continue. It's going to be an emerging market debt crisis, a Chinese debt crisis, and that's exactly what we're seeing in the charts. So let's get into the economic events that matter this week before looking at those charts that matter, the technicals that are just showing all of these things on the charts coming true. Economic events that are important this week, we're looking at EU and German market PMIs, obviously going to be a big signal as to how the EU and German economies are holding up in this current environment. We have Australian inflation figures coming out on Tuesday. We have the BOC interest rate decision, and most importantly, the Fed interest rate decision, which I believe will stay unchanged because it's too early for them to hike rates, but there'll be a lot of eyes on the FOMC statement, which will kind of indicate what their plans are moving forward. Any changes in that FOMC statement could have big implications to the US dollar and the global economy moving forward, as we've just explained. We have Thursday's US durable goods orders and US GDP, obviously a good indication of what the US economy is doing. If the economy is really flowing and durable goods orders continue to be strong, that's going to be a big indication that the FOMC is going to have to start hiking rates. So that's going to be a big one. And then Friday, we have German GDP figures, obviously showing how Germany performed in the latter half of 2021 in terms of their economic output. And heading over to the charts that matter this week. Obviously, the dollar is going to be massively important at these levels, whether we're going to see a continuation of this downtrend in the dollar, or are we going to start to see the dollar bounce from these levels? When we look at the structure of the dollar in terms of its corrective move, it's possible we're still looking at part of this as, I believe, this corrective move, which could see the dollar kind of fall down towards 94 before taking off. But I'm kind of leaning more towards dollar strength from this region, lower time frame structures showing more of a corrective move that resembles further upside. As you can see, we had this ABC corrective structure that kind of bottomed out at that 94.70 region and then just took off from there back into, most importantly, this corrective zone, which usually these charts don't usually or would do if they are heading lower. There's still a possibility, a couple of scenarios that point towards that, but from what I'm seeing now, I believe this was a move to the upside. We are now seeing just a short-term correction in this region, and then we will see a continuation of that dollar strength moving forward as those Fed rate hikes come into play. We're seeing very similar pictures in the euro, the pound especially already rolling over. When we zoom out on the pound, we had this really beautiful expanding running triangle, very difficult pattern to kind of identify, but the price action we saw this week was very indicative of that structure, because we've had a massive move from those highs at 137 down to 135 this week, indicating a continuation of that move. So now we'll be looking for a lower time frame corrective structure in here before we see the pound roll over to the downside, obviously showing US dollar strength. Aussie dollar is another one coming out of the zigzag correction, ending the week at new lows since basically the 12th of January. And more importantly, in a very strong downtrend following this little ABC corrective structure. So all of these commodity pairs are really rolling over. New Zealand dollar, US dollar approaching new lows for the year. US dollar CAD turning to the upside here. I think there's maybe still a little bit more downside in the US dollar CAD down towards 124 to 123 region, but it is all indicative of a corrective structure that indicates longer term strength. As you can see, beautiful ABC flat pattern, which we believe will see the US dollar CAD going to new highs within the next kind of 6 months to 12 months. Importantly, silver continued to rally this week, had a really strong week, but kind of rolling over towards the end of the week. I think that was all just a corrective zigzag. Again, lots of zigzags in the market at the moment, indicating the end of the move, and is now heading down from here. As you know, we've been bearish precious metals for some time, and we believe silver will continue to roll over heading into next week. And then moving forward, once it breaks this 2170 region for the third time, we're just going to see that really fall through the floor, especially as the Fed continues to draw liquidity out of the market and inflation expectations roll over, which is the reason that silver rallied in the first place. Same with gold. I think this rally we saw this week was just a corrective move, a zigzag following an ABCDE expanding triangle, part of a bigger corrective move, and we all part of actually this move down here now, this A of B, which we are now part of the C of B, that's going to be heading down towards kind of 1675 once all of this kind of unfolds and unplays. And when we see the structure here, again, expanding triangles just all over the place, and we look at the move up compared to the second move, that ABC, very indicative of a turn, which is possibly what we saw towards the end of the week. When we go to the lower time frames, you can see how we've really rolled over, MACD's rolled over, and we're just looking for continuation to the downside in that gold chart. And obviously an important chart is the copper gold ratio, because if this rolls over, then we'll definitely be seeing that those inflation figures are starting to drop. And if inflation starts to drop, it kind of plays to that narrative that we're seeing an economic slowdown across the board, more than likely as a result of China rolling over. And we still have that kind of head and shoulder structure. We've seen a little bit of a rally from mid-November, which we weren't really expecting. We're expecting to break down from here, but all of this just looks corrective to me from this bigger impulse that we saw off the highs. So if this impulse off the highs is now just in correction for continuation to move forward, then we'll see inflation rolling over. Oil is going to be an interesting one. We saw new highs in the oil markets heading in the last couple of days. On the higher time frame charts, I suspect we will be rolling over at some point, but there's still the possibility we get up to $100 oil. When we look at the narrative that the European debt crisis pushed oil lower, it actually took a good kind of 2 years before oil rolled over properly, but stayed in that region of the European debt crisis for some time before really plummeting. So we may be seeing something similar, oil holding up really well before the kind of economic consequences of the debt crisis actually take effect on the oil market. So we could see $100 oil before we roll over. We'll just be keeping a close eye on that. Obviously, the S&P this week showing some really bearish signals, as you can see, coming out of this rising wedge, and then really melting down back to levels we last saw basically in October 2021. There's still a possibility that we rally from here, because this is indicative of a kind of ABCDE expanding triangle once again. But this week's close that we saw is really showing how bearish this market is. Just look at these bearish candles, one after another, 4 in a row, massive bearish candles. We had massive options expiry happening on Friday, so we may just see a bounce at these levels heading into next week. But we'll have to just wait for indications that this market has properly rolled over, and we will be continuing to see downside in US equities. And that kind of tends to be the case as Fed pulls liquidity from the market pulls its funds out of the stock market, and we see the stock market roll over. So we'll be watching that pretty closely. And then finally, just heading into the crypto space, Bitcoin still under serious pressure, already down fully 50% from its highs that we saw back in November. So that's a very, very big move to the downside. Kind of a couple of strategies here, a couple of possibilities. I believe we should see kind of 30,000 here, and then potentially a bounce from that region, but it really depends on how you're looking at this chart. If we look at it from a weekly perspective on the log chart, which tends to be the case when you look at longer term charts, there's still the possibility that Bitcoin goes sub 20 here. That's something we've been talking about since May of 2020. And definitely seeing this roll over in October. There's still the danger of going sub 20 before we push higher from here. So we'll be waiting very patiently for the turn. We won't be getting into too many bounces. We'll wait patiently for the turn and an indication that we are going to continue higher at that 30,000 level. But if we don't get that, there's still very much the possibility that we head down sub 20 back into the 2017 corrective beginning, and all of that will form part of a longer term ABC corrective structure. And once we see the bottom of that, we will see probably 100,000 on the next leg higher, and beyond that if Bitcoin is going to survive the current meltdown. So we're keeping a close eye on that. And obviously Ethereum showing very similar structures. Maybe we see a dip below 1,000 in Ethereum, which is obviously a really big move from here. Or we just look at the shorter term charts, look at the shorter term structures, and we'll see how we could bottom out at around about this 2,000 region before things continue from there. So we'll just have to be really patient with these markets, because getting in too early could really hurt. But if you do have the belief that these crypto markets are going to survive the next crisis and we will see a continuation, which I tend to believe, you may just start to dollar cost average in at around about that 2,000 level and just continue to buy on the way down from there. There's a pretty decent level to be buying in terms of risk reward to the upside. So cool, guys, as you can see, lots going on in the market at the moment. S&P rolling over is a big warning sign for the global economy. Obviously China still playing a massive role in that. The Fed and their actions moving forward is going to play a massive role in that, and emerging market debt, as we keep saying, is going to play a massive role in that moving forward. So those are the things we're really going to be focusing on over the next few weeks, keeping an eye on, looking at the news headlines, looking at the charts, and we'll continue to update you every week, every Saturday with these videos. So please subscribe, even get a little alert for yourselves just to keep an eye on these things, and we will keep you updated with the latest in financial news moving forward. It's cool, guys. Thanks for watching. Really appreciate you, and we will chat again soon.